Forget everything you've heard about just budgeting better or making extra payments. No, this explainer is different. We're diving into 5 powerful and honestly pretty surprising strategies that actually work with the student loan system to save you a ton of money.
You know the one. We've all been there. You see that letter or that email pop up and your stomach just drops. It's this universal feeling of dread and confusion when you're staring down that huge number. It's not just a bill, right? It feels like this massive weight on your shoulders.
But here's the thing. All this jargon you hear about forgiveness, consolidation, refinancing, it can feel so overwhelming. And the usual advice is just throw more money at it. But what if there's a smarter way to play the game? That's exactly what we're going to figure out today.
So let's kick things off with our first big secret. This one tackles one of the most misunderstood tools in the entire federal loan system.
When most people hear income-driven repayment, or IDR, they think it's just for emergencies. You know, a last resort for when you lose your job or you just can't make ends meet. It's seen as this temporary fix, not a real, long-term strategy. But that is a huge misconception.
So here it is, secret number 1. IDR isn't just about survival, it's a powerful strategy. For a lot of people, especially anyone aiming for loan forgiveness, intentionally paying less each month through an IDR plan is actually the smartest financial move you can make. I know, it sounds crazy.
Okay, so let's break down how this actually works. An IDR plan caps your monthly payment based on your income, not how much you owe. Now, yeah, this does extend your loan term to 20 or 25 years, but the key is what happens at the very end. The entire remaining balance is forgiven, wiped out. The genius here is that by paying less now, you leave a much larger balance to be erased later on.
Now let's move to our second secret, because this builds on that idea. This one is all about the temptation of refinancing. It can feel like such an easy win, but it often comes with some serious hidden costs. I mean, this analogy is just perfect. When you refinance your federal loans with a private lender, you are permanently, totally ending that relationship. There is no going back. That lower interest rate is tempting, for sure, but you have to understand exactly what you're giving up.
And here's that trade-off, laid out plain and simple. With federal loans, you keep this whole safety net, the strategic IDR plans we just talked about, options for forbearance, and, this is crucial, eligibility for all the forgiveness programs. The moment you refinance privately, you might get a lower interest rate, but you give all of that up, forever.
Okay, speaking of forgiveness, our third secret uncovers a massive, time-sensitive opportunity for anyone working in public service. Seriously, this is a big one. You're going to want to listen up.
But first, a super important point of clarity. We just talked about the dangers of refinancing. Federal consolidation is completely different. All it does is bundle your existing federal loans into a new federal loan. You stay inside the federal system, and you keep all those benefits we just saw. And this little distinction, well, it's the key to unlocking our next secret.
And here's why that matters so much right now. For a limited time, a temporary waiver has totally changed the rules for public service loan forgiveness, or PSLF. And this isn't some small tweak. It is a monumental shift that has opened the door to forgiveness for thousands of people who thought they'd never qualify.
So here's the hack. Normally, these older federal loans, like FFEL or Perkins loans, they don't qualify for PSLF. But under this limited time waiver, if you consolidate them into a new direct loan, the government will actually go back and count your past payments toward forgiveness. This is a massive shortcut that could literally shave years off your repayment.
All right, let's stick with PSLF for our fourth secret, because there's a really common myth out there that stops so many high-debt professionals from even looking into it.
This is what so many people think, right? They hear public service loan forgiveness, and they picture social workers or teachers making pretty modest salaries. They assume that if you're, say, a doctor at a nonprofit hospital or a lawyer for the government, you just make too much money to benefit. Well, that is completely wrong.
$300,000. You could owe this much or way more. It truly does not matter. The PSLF program has no income cap and no loan balance limit. Your salary and how much debt you have are just not part of the equation.
The requirements are actually this simple. It just comes down to 3 things: making 120 payments, that's 10 years worth, working for a qualifying employer, like a nonprofit or government agency, and being on a qualifying repayment plan, like an IDR plan. That's it. There's no fine print about your income.
And this brings us right back to our first secret. If you're on the PSLF track, your goal is not to pay off your loan.
Your goal is to pay the absolute least amount possible every single month, using an IDR plan for 10 years straight. That way you have the biggest possible balance left to be forgiven, completely tax-free.
Okay, on to our final secret. This one shifts gears a bit over to private loans, and it offers a path to genuine financial independence that a lot of people just don't even know exists. So, if your parents or maybe another family member co-signed on your private student loans, you might feel like they are stuck on the hook with you until that very last payment is made. But what you might not know is that many private lenders have this co-signer release option buried deep in the paperwork that they don't exactly advertise. Now, the process isn't automatic, but it's pretty straightforward. Typically, after you make anywhere from 12 to 48 on-time payments and can prove that you have enough income to handle the loan yourself, you can formally apply to have your co-signer taken off the loan. It's a huge step toward your own financial independence and, a great way to relieve a loved one of that burden.
So after all this, the question isn't just about what you learned, it's about what you're going to do. Are you going to check your loan types for that PSLF shortcut? Or maybe look into an IDR plan? Or are you going to call your private lender about a co-signer release? Moving from feeling overwhelmed to being in control, it just starts with one single strategic action. What's yours going to be?